The past month has been an uncertain time for the US dollar. The planned reopening of some US state economies has been a captivating positive for the market. Against this, however, is the mounting US cumulative case count, which raises the risk of rolling restrictions shutdowns over an extended period. In addition to these idiosyncratic factors, uncertainty around the dollar is also being created by debate over whether the US or its key trading partners, such as Europe and the UK, are better positioned to recover. It is not surprising then that the past month has seen the US dollar essentially mark time, trading in a tight range around the 100 index level on a DXY basis. As per our May Market Outlook publication, up until the past few weeks, the risks surrounding Europe and the UK have been seen as greater than for the US. This is because Europe and the UK lacked momentum ahead of COVID-19, were hit earlier and harder by the virus, and had to take more stringent actions to restrict the virus's spread. But in the months ahead, the growth disparity between the euro area and the US looks set to stabilise and then narrow into year's end. The logical market implication of this development, to our mind, is that the euro should stabilise against the US dollar at 106 in the second half of 2020. Sterling should similarly find a base near the current spot at 123 between now and the end of 2020. Come 2021, the euro will benefit increasingly from confidence in the global economy, led by China and the rest of Asia. Europe should benefit more than the US from this development, as Asia is a key source of demand for Europe's industrial and consumer-centric exports. On a bilateral basis, our economic expectations would be supportive of the euro rising modestly from 106 at the end of 2020 to 110 by December 2021. Sterling is likely to experience a similar lift. To the above views for euro and sterling, the spectrum of risk is skewed to the upside. The chief reason is that in opening up its economy while COVID-19 is still so prevalent, the US risks multiple waves of the virus and associated policy missteps with material consequences for the population and the economy. Turning to Asia, it has been interesting to see Japan's yen outperform recently, despite terrible economic outcomes there as well. To our mind, there are likely two key factors at play. First, the spread of COVID-19 in Japan is a startling contrast to the US. Just 51 new cases are being reported for Japan by the WHO as we record this update. That compares to almost 26,000 new cases in the US, creating good cause for the yen to act as a safe haven, even against the US dollar. Second, while the Bank of Japan has led the charge on alternative policy easing over the past decade, they had very little room to aggressively expand asset purchases and other alternative policy measures from here. In contrast, the US FOMC has nearly doubled their balance sheet in response to this crisis, to around $7 trillion, and hereafter it will likely add another couple of trillion to this balance. While risk perceptions and policy favour the yen in the near term, Japan's medium to long-run economic growth prospects are weaker than the US and potentially Europe. This leads us to expect a reversal of 2020's yen appreciation in 2021. Sustained gains for currencies in Asia will instead be focused on nations with the strongest underlying growth prospects. Highlighting this best is our expectation for China's renminbi, which we see appreciating by more than twice the fall that we forecast for the DXY US dollar index overall to end 2022. We'll see you next week.